would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. I hope all is well with you as we head on into the Thanksgiving holiday. I hope you all have lots to be thankful for. I'm just thankful. I feel like I'm starting to come out from under this freaky illness that's been floating around my house for the last week or so. I haven't quite been myself for the last week. Hopefully I've turned the corner. Now it sounds like my oldest son may be coming down with whatever it is. But we're going to head into the Thanksgiving season, focusing more on the things that we're happy about, which I think is appropriate. And I hope you've all got plenty of things to dwell on that are going to make you smile. I hope you're all going to spend some time with family and enjoy that as much as you can. I realize how much of a mixed bag that can be. It is the real world after all. But let's try to enjoy each other's company as much as we can. You know, I was trying to figure out with the timing, because odds are I'm not going to be doing a show on actual Thanksgiving Day. I just can't imagine folks out there going to the trouble of wanting to spend time with me on Thanksgiving. But I'll probably go ahead and post a show, but it'll be like a best of type of thing. I'll pick a show from way back when that's more generic, that kind of talks about a general approach to something, so it's not as news-based as some of the things we talk about are. But today, for the day before Thanksgiving, I guess I should have tried to find something a little bit more upbeat, but I was sort of taken aback by a couple of different things. There's actually two subjects that were really fighting for my attention today. And the translation will probably be that that'll equal two shows. But the one I opened first relates to the Federal Reserve and rates. Now, we've had this talk before relating to the things you want to pay more attention to if you're trying to actually anticipate near-term changes in interest rates for mortgages. But what eventually all of these things is of what the Fed does down the road tends to have effects. We've talked about it, whether it's an emotional side effect, folks just worried, and their reaction is more relating to a sense of worry than it is about whatever number came up. But there's no question in my mind, just as I was telling you a year ago, more than a year ago, just as I was telling you 2 years ago that there would be no rate hike the first bunch of times. In fact, I didn't even think there'd be one at the end of 2015. And then at the end of 2015, we got that very, very small raise from the Fed in the prime rate, which resulted in exactly what I told you would happen if the rate did go up, which was a short period of concern. There's whenever things change, right? There's always that fear of change thing that happens. So people react a certain way. So you can always count on anything like that causing a less than reasoned response. So you always get a little bit of a boost in interest rates, which is exactly what happened. But then 2 weeks later, interest rates were down below what they had been prior to the raising of the interest rates by the Fed, right? We called all of that on this show. We were right on the money. Now I'm telling you that in December, the Fed will raise rates. It has to happen. They don't have a humongous election hovering over their heads anymore. And the perception is that it needs to happen. They tend to try to talk about the great underpinnings, the recovery that's going on. We've talked about the nature of the recovery and how strong that is or how weak it is. But I have no question in my mind that in December we're going to see a rate hike. So I started wondering, what should we set as expectations? And so I went and I Googled the subject, and I came across some really interesting articles, but what's most interesting about them is they were from this time last year, talking about the expectations. It was actually earlier in the year of 2015, back in September of 2015, when they were expecting big raises in the prime lending rate from the Fed. And at that time, we were telling you that that's not going to happen, and we ended up being correct right up until the very end. We called it correctly the first 6 or 7 times, and then that last time in 2015, they actually did raise it by a very, very small amount. And that kind of fit with my alternative scenario. If for those of you who've been listening for a while, you know that before they did do that raise late last year, I told you it would be a relatively small raise that would be intended more as a gesture to try to show a sense of confidence, and that its overall effect would be negligible, and that's exactly what happened. So, in fact, it was less than negligible. It gave us 2 weeks of slightly elevated rates that then returned to rates that were below the rates they were before the uptick. All right. The first article that jumped out at me was from CNBC, and I think what really jumped out at me was the very first line in the article, which is, quote, "A rate hike will come, and the bull market will stumble. Bond yields will climb, and the economy will slip into a recession." And the following line is, "This we know." So there you go. Thanks for tuning in, everybody. I appreciate you taking the time to listen to what I have to say on these subjects. No? Is that just a short version today? Because that's exactly, it's the most frank and real honest assessment of what happens when interest rates go a certain direction. But here's the reality. You don't avoid doing a interest rate increase or a rate increase from the Fed because you don't want to get into a recession. Going too far either direction is a bad thing, right? So this is something that has to happen. So let's try to mentally prepare for it. Instead of having it surprise us, let's be ready for it. So, because there are variables, right? And we're gonna talk about some of the history of these interest rate increases and how long it took for the effects to really kick in terms of hitting the market. So the 2 questions we need to try and answer are how long it will take and how long it will last. In other words, how long will it take to get to it and how long will it take to last? For the economy specifically, and I'm quoting the article again, history offers little guide about timing. Quote, "A recession has come as quickly as 11 months after the first rate hike and as long as 86 months after a rate hike." So that gives us a pretty broad window, an 11 to 86 month window. And, I've lived through a couple of these, but, nothing is more fresh than the more recent things, obviously. But in looking at the history of these, I just can't help believing that the foundations that underpin a lot of our economy right now are not as strong as they need to be to handle this in ways we've been able to handle it before. We have debt levels that are absolutely historically unparalleled. Absolutely unparalleled. Trillions of dollars. Absolutely insane. We have a job market that is absolutely not as robust. Regardless of the number of people who officially, quote unquote, have a job, the quality of those jobs on average isn't as good as we'd like them to be, right? So there's a lot of things that have me concerned. One thing that we know has been going on is that the Fed has been propping up these low interest rates because they've wanted to preserve the market. And what's the market doing right now? The market's been going nuts. We had a downtick right after Trump got elected, and then there's this rally that kind of happened. So the market has sort of been just jumping right now. And this will likely tend to slow that stuff down. So in relation to the stock market, let's see, let me quote here. "It does seem that there's a trend for equity returns to stall 12 to 24 months after the first hike, which again perhaps reflects the lag in monetary policy. More specifically, the market over the past 35 years or so, most often up sharply, about 14% at the time of this writing, which was over a year ago, heading into the rate hike fairly flat in the 250 days after, with an average gain of 2.6%. Then back to normal once 500 days have passed, with average return in the past 6 cycles of 14.4%, according to a recent analysis Bob Dole chief equity strategist at Nuveen Asset Management, posted on Barron's. And I remember this is all a year ago. The question I want to ask, and the question I want you to ask yourself is, this was their perception of what was going on a year ago, more than a year ago. And honestly, we're not better off today than we were 16 months ago. So it would seem to me that the stage that we have set now for this expectation is a less bright one, right? A potential for us to have bigger hardship. So does that spell this stuff coming on more quickly? I think given where everyone is, that 11 to 86 month thing that we talked about, I'm guessing we're closer to this hitting within like at the 11-month point, maybe even setting a new record in terms of how soon it comes on, which could absolutely affect where your plans reside. Because let's continue with this. Hiking rates into such a fragile economic backdrop could be risky and set up the question of whether this time is different. Market participants have been bracing for a Fed hike all year. And again, this is 2015, with all eyes turned toward the week's Federal Open Market Committee meeting, which ends Thursday. While many strategists and economists believe the FOMC could approve a hike at this meeting, futures trading indicates just a 25% probability. In our study since 1950, all hiking cycles to date have been in a super cycle of increasing leverage, with GDP eclipsing pre-recession peaks very quickly post the recovery commencing. By contrast, this has been a uniquely slow recovery from what was the worst recession in the sample period. So we're coming off of the worst recession within the period they've measured. And what I thought was interesting is the rate hike cycle. The rate hike cycle, they have one here from 4/15 to 8/23, 1957, where there was a cycle of repeated increases, slow but steady increases in the rates. It went on for, the duration in months was 28 months. And the next recession hit in August of 1957. So the time of the next recession was 28 months. The next one, 9/12/1958 to 9/11, 1959, 12 months of hikes. April 1960 is when the recession hit, and the time of the next recession was 19 months. Let's see. Let's get to some more recent stuff here. 6/30, 2004, 6/29, 2006, 24 months. December 2007 is when the recession hit, and the time of the next recession was 42 months. So they give an average duration of 22 months, a median of 14. Time to the next recession, average 41, median 33. The current cycle is by far the longest the Fed has waited since the end of the last recession. The record has been 35 months, and this is 74 months and counting. So add 16 months to that, right? Which gives us 90 months. Bonds, the expected effect on bonds. It does seem some yields change direction immediately as the first hike cut in the cycle arrives. At the end of the hiking cycle, bond yields fall immediately. Bad. That's bad, right? We've talked about what part bonds play just in what we were talking about yesterday in terms of pensions. That just puts a bigger caliber gun to the head of those trying to manage those pensions, since so much of what they're invested in is that exact kind of thing. Charles Schwab strategists believe the hike in rates will cause yields between longer and shorter dated bonds to move closer together, flattening the curve. High yield bonds often perform better in such a climate, though. We are still cautious about stretching for yield. They give sort of a basic rundown here on the winners and losers that I thought was worth taking a look at. Broadly speaking, companies that do the majority of their business in the U.S. will win as interest rates rise and local products become more attractive. Multinationals with lots of debt will fare worse as a rising dollar makes their products more expensive in the global market space and their debt more expensive to finance. Quote, history shows that quality stocks tend to outperform during the 3 months following an initial rate hike, Goldman Sachs analyst said in a report for clients. Firms with strong balance sheets outpaced weak balance sheets sheet companies following each of the 1994, 99, 2004 rate hikes by an average of 5 percentage points. Companies with high returns on capital as well as low volatility stocks also outperformed their lower quality counterparts by an average of 4 percentage points. What I find interesting about this is there are a lot more folks saying that we can expect the stock market to be hit harder this time with a rate increase. We're going to have to see how that goes. Now, and eventually, a rate increase from the Fed will filter down. It will end up affecting the lending scenarios. Again, the more leading indicator is that 10-year Treasury note. So I'm not suggesting you stop looking at that. That's going to be your main thing. But the raising of these interest rates is also something that affects that 10-year Treasury note. So when that goes up, then that tends to be what your indicators are. My concern is this. I think that given what we've talked about, that there is absolutely reasonable room to be concerned and try to figure out whether or not this change in the economic landscape is something that you should be looking at as a factor in accelerating or delaying or in some way changing your real estate investment plans, or your real estate plans in general. If you're thinking about selling, if you're thinking about buying, is it better to start pushing to do that now or not? And are we also in a situation where circumstances have kind of come together to actually make this just one more reason to accelerate some moves? We're going to talk about all those things in a second, but first we're going to take a break. So don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We just spent the first part of the show taking a look at the impending Federal Reserve rate increase. I feel comfortable calling it that. I have no question in my mind they're going to do it. I don't see any funky political reasons to not. I don't see us being in a position where things are bad enough in any single area. Or if you look at the circumstances under which they raised rates last year at this time, there's no question that the circumstances now are at least as good as then in terms of the metrics that they seem to care about. So interest rates will absolutely go up. It'll be interesting to see by how much. Last time they did it, they raised it from 0.25 to 0.5 basis points. So we'll see if they end up going for a full half basis point. My feeling is that they'll do something subtle. And so it's interesting to kind of see what that spells for us. And people don't realize how much the reaction often defines what's actually going to happen in terms of self-fulfilling prophecies, people being worried and then taking actions based on that worry, those types of things. But if we try to pin it down to exactly what you need to worry about. Now, as I mentioned before, mortgage rates are pegged to treasuries, so it's really only how much this affects treasury notes primarily, and it will to some degree. But I think what we'll see is what we saw last time. We'll first see that fear of change element, because think about it, an awful lot of the folks who currently work in these financial areas are now young enough that they may have or been in the business a short enough time that aside from that 0.25 basis point increase last year, they've never actually worked in the industry when rates were higher than 5%, which is kind of a mind blower. or maybe even higher than 4% in a lot of cases. Although 4%, that's for mortgage rates. But if we're just talking about higher than 1% for the prime rate from the Fed, right? Those folks have never seen that. So we may actually find ourselves in a position where there's going to be a lot of concern when this happens. And I think the same thing will occur as last time. We'll get that first couple of weeks of freak out, and then things will settle down a little bit. Do I think they will settle down as they did last time to rates that are lower than what they are now? I'm not as certain of that. I think that they'll settle down, that we may see right now. I've been seeing rates. I was just quoted a rate. I rechecked my rate yesterday, and it was 3.85. I understand that nationally I'm seeing rates in the area of 4.1, 4.2. It wouldn't surprise me if we see rates go up to a 4.5 and then come back down to maybe a 4.3 or a 4.2 and maybe go back to right where they were. Do I think they'll go lower than what they are now? I honestly don't. From the standpoint of you as a buyer, there may be a good argument to make that the longer term prospects are that interest rates are going to continue to go up. I think that this first increase is just going to be the first of a more regular set of increases over the next year. So if you're looking to buy and you really want to try to leverage off of cheap money, this may be a good window for you. If we're talking about the folks out there that are taking less of a practical approach or less than an analytical approach and sort of going with emotion, right? We've tried to peg before. What's the magic number? What's the magic number that doesn't stop people from taking a loan, but has them say, okay, we really need to do something now before it goes any higher than this, right? So I've been trying to figure out what that magic number is, and I think it's when we get to the high fours. Maybe 4.8, 4.9, and I'm guessing when it hits 5, that's the tipping point where we may see a whole bunch of people who say we got to get going before it goes any higher, and then once it goes over that amount, that's when you start to see a relatively large decrease in the number of folks who are buying, or as will happen as we move up to that number, because of course not everyone's going to react the same. So what we'll see as interest rates go up is buying demands change. So instead of someone saying, all right, I am qualifying for a loan of this amount, so I'm going to buy do a search for a home of this price, they're simply going to reduce the price of the house that they're shopping for. That's an interesting point because it changes those windows we've talked about before in terms of bracketing of prices, where the most action is. It shifts that entire bell curve down. So the folks at the high end are going to get stung because there's going to be fewer people willing to pay that 1.2, 1.3 million bucks for a house, depending on where your high end market lives. I realize it's different in every town. I'm sure there's towns across the country where the high-end price point is $400,000, $500,000. And those are the folks who are going to get hit more. It really just depends on the curve in your marketplace in terms of where the biggest number of buyers live in terms of how much they're willing to pay. That whole thing's going to shift down a bit as interest rates go up. So, given that, those of you who are looking to sell should seriously think about where your home is in terms of that shift. If you tend to be at the higher end, any shift to the right, which would represent an increase in interest rates, right, where the buyers are now looking for less in terms of how much they're going to pay because they're buying their monthly payment. They're not buying the house for the full amount that they're paying. They need to make sure that their cash flow is good. You may need to accelerate your desire to sell your property to take advantage of the fact that interest rates are low and you're going to have a higher pool of buyers out there. For those of you who are down towards the midpoint in terms of average prices for your communities, you're probably not going to be affected that much in terms of demand unless there is an overall reduction in demand. But I really don't think that's going to be a primary thing until we get closer to that tipping point interest rate. And I'd love to just put a nail in the ground and say this is it, but I really don't know what it is. But I'm guessing, as I said, it's going to be somewhere in that high 4% range, perhaps even 5% before we start to see really noticeable declines in the folks who are out there buying. And of course, I'm speaking from my ground truth, right? This is what I expect to happen in Silicon Valley in terms of the folks I'm seeing. So for your mortgage rates, yeah, we can absolutely expect some effects here, but it's going to have that weird blip as the emotional response kicks in. Then it'll calm down. Then as we start to see the changes from the Fed as it works through the financial system, as treasuries get affected, then that's when you're going to start to see interest rates on mortgages tend to creep up. But my advice, and this is the advice I'm taking for myself, if interest rates do jump after this uptick, wait 2 weeks and then you'll probably be okay. If you wait 2 weeks and it doesn't come back down, start to settle back down a little bit, start looking for why. That would indicate to me there's something else going on that's got people freaked out a little bit. If for auto loans, low interest rates are not going to have any material effect on borrowing costs, so that's not anything to worry about. Credit cards, not something to worry about. Student loans are fixed, so most borrowers won't be immediately affected by a rate hike. But if you do have a private loan, those loans may have a variable rate tied to the LIBOR, prime, or T-bill rates, which means that if the Fed raises rates, borrowers will likely pay more in interest, although how much more will vary by the benchmark. So if we look over the horizon, does this tend to spell a change in the landscape? Now, we've also talked before about the uptick in all cash purchases that took place for a while, right? I think we talked about that. I don't think we mentioned it today, but it was a scenario where the folks who were the increase that we saw over the last year wasn't so much the typical thing we saw before. It wasn't investor properties, really. It was tended to be properties at the higher end. And I think the primary reason for that was folks were moving money from one investment vehicle to another. It wasn't because these folks were really real estate people. It was because they were interested in shielding their investments and protecting their cash. I think that trend will actually tend to continue. I don't know if it'll get bolstered by more and more all cash stuff. We are seeing a continuing surge in foreign investors after we saw that downturn earlier in the year. So there's definitely a lot of concern in a lot of different circles. At least it feels like concern in terms of what trends we're seeing and what folks are expecting from the market coming down the road. But I'll tell you what, I know that in my own business, now I've tried to sort of, as I move through the various steps, I've tried to keep you up to date on what my thinking is and what actions I'm taking relating to my own real estate holdings. And given where things are right now, I had a plan where I was going to put my home on the market to the point where I was going to get it. I was going to do a lot of remodeling here in January, February, and March, get the home in there just before May. May is the peak month for price in terms of getting the highest dollar amount for listings. I had it all planned out. The more I look at this, the more I'm thinking I would, because of the price point I'm at in my community, I would be negatively affected by a shift in that bell curve. And I think there's a very real possibility that there might be another rate increase after this one in December before I'd be able to get the home sold, which could serve as another cooling factor on buyers or get folks more concerned about interest rates. So I'm actually toying with coming up with a plan where I sell it prior to actually doing the remodeling and try to come up with a way to make that a marketing thing. So I'll let you know what I come up with. I've got a couple of different things bouncing around in my head, but it's something I wouldn't mind doing, and then it's sort of accelerating the process. Because I'll be honest, I think that a lot of what we're seeing is going to, in my marketplace, have a negative effect on average prices. Very interested in seeing how this affects the hot season next year. But I wouldn't be surprised if we were already kind of in a cooling mode, at least in a lot of markets that I'm currently working. We have a couple of markets further north, up closer to San Francisco and up the peninsula, where there have actually been a big uptick in the number of sales that have been happening, but again, still flat on prices. So we'll kind of see how it moves along. It's been interesting as it's sort of taken a holding pattern, at least in terms of prices, but with continuing relatively short days on the market and sales looking pretty robust. So it's going to be interesting to keep our eyes on these markets as we move into 2017. All right, folks. I absolutely appreciate you going to the trouble of including me and spending your valuable time chatting with me about real estate. I hope that in return, I've given you some interesting things to think about. As always, you can find me at the website at www.therebelbroker.com. You can send along any ideas, suggestions, observations, or questions that you might have. If you'd like to get yourself into the drawing for the $50 Amazon gift card, head over to the site at therebelbroker.com. Click on the big red button at the top that says take the survey to support the show. Use the same email address both times you're asked. Answer a handful of questions, and you are entered. As long as those two email addresses match, you are set. So jump over there, take advantage of that. We've already given out the $100 worth of $50 Amazon gift cards. So get yourself in there, and in the first part of December, we'll do another drawing and pick ourselves another winner. And finally, if you'd like to join the Rebel Underground, text the word Rebel Broker to the number 44222. That's text the word Rebel Broker to 44222. And it's as simple as that. Once you've done that, you'll be asked for your email address. It'll verify who you're giving that information to, and then you'll automatically be added to the Rebel Underground list. Thanks again for listening, everybody. I'll talk to y'all next time.